screen control, and
Okay,
you've got the
great.
first slide with you, and the first slide will just be you talking, Sabrina, and just say, hey, we thought this tax-related webinar would be great for small businesses, stressful topic. And then top of your inbox is the couple sentences about who Ryan is and why he's qualified to talk about this.
Okay.
Yeah, you should be able to throw it just straight to him right after that.
Okay, sounds great.
Cool.
So yeah,
and
Sean,
Ryan, sorry, go ahead.
I was going to say I'm ready to go to just kind of start and just tell people.
Okay, and it looks like the bulk of people have already logged in, so we'll probably have a few people joining as you start up, but you can go ahead and start as soon as I make it live then.
Okay, great.
Ryan, can you just confirm your audio is up and running right now?
Yeah, we're good.
Perfect.
Great.
All right, I'm going to go ahead and start in 3, 2, 1.
The broadcast is now starting. All attendees are in listen-only mode.
I want to welcome everybody to our webinar this morning. I'm really excited to have Ryan Clower from M. White & Associates, based out of Plano, Texas, joining us to help give some advice about taxes and small businesses. And obviously, 'tis the season right now. We're getting near that April 15th deadline. And oftentimes, businesses have different deadlines. But if your business is a pass-through organization or depending on the legal entity, then April 15th is a deadline that is important to all of us. So very timely. M. White & Associates is a firm that is passionate about small business owners and really focused on helping them achieve their financial goals. They work with business owners nationwide to get a better handle on their financial performance through financial consulting and proactive planning, which we at Palo Alto Software, the makers of LivePlan, love to hear. One of our favorite things to do is work with accountants who are helping small businesses and really teaching them all about what proactive planning is. The more that you do some of this proactive planning, the better your business will do, and it'll help you understand and plan for taxes that will be better off for your business. So it really kind of all goes hand in hand. And they love to educate their clients, and that's why we have Ryan with us here today to provide some education into the often complicated world of business taxes. So with that, I'm going to hand it over to Ryan. You can see that on the screen here, I've got my @MommyCEO Twitter handle. When I'm not running Palo Alto Software, I'm pretending to be the boss of my 3 children, although apparently very often I'm not supposed to be the boss of them. But that's why Mommy CEO, and I'd love to hear any questions you have. And of course, throughout this webinar, Ryan will be focusing on a lot of in-depth information, and we will have questions come through in the question section in the GoToWebinar panel that you see, so please ask them. If we don't get a chance to answer your questions, we've got everybody who's registered for this webinar, we've got your email addresses, and we will go ahead and field some of those questions and send out an email with the recorded webinar as well as with some answers and maybe links and resources after this webinar. So we're going to have some help fielding the questions, and we will save the questions to the end. But please go ahead and ask them while we go through. So with that very lengthy intro, Ryan, I'm going to pass it over to you.
Yeah, Sabrina, I really appreciate that. And, I'm excited to be able to be here with you guys today. We've been working with, our firm has been working with LivePlan and the folks back there to really kind of help business owners get a better handle on, from a consulting and a business financial performance sense, get a better handle on their business and really achieve their long-term goals. So I'm excited to be here. I am a CPA down here certified in the great state of Texas. Really just stoked to be here. I'm one of those people who I geek out in a tax sense, right? And that's few and far between in this world, but I'm one of them. So I think this presentation is right up my alley. We're a firm that prides ourselves in education with our clients, and that's really because we want them to have a handle on their business financials and their personal financials. Today we're going to go into 5 critical tax tips to reduce your business taxes this year. Lengthy title. We couldn't figure out what to call it, but it's about taxes. It's that time of year. So bear with me as we get going here. These are your 5 tax tips for the day. Write these down. We can end the presentation here shortly after. So, no, just kidding. You don't have to write those down. Here's the problem, and I'm not going to go back to them, and here's the reason why. Most people, especially during tax season, will jump out there on Google. They get their tax bill, they hear from their CPA, or they're kind of running around and doing it on TurboTax or something. They jump out on Google and say, how can I save on my taxes? The problem is, just like in that previous slide, you see 5 generic tax tips, and many times you see 50 or 100, and they're not necessarily applicable to you and to your business. Applying tax tips and tax advice really has to come through a holistic approach to knowing your situation on the personal side and your situation on the business side. As business owners, it's a complicated world out there. I realize taxes are one of the most complicated of the things that you have to deal with in your life. If you have solid tax advice and you have solid guidance in all areas, you won't have to use Google to try to meet your goals. As I mentioned, asking why. All of our business owners, I really work with them on a month-in, month-out basis. They call me all the time, not only to talk about their business financial performance, but to talk more about why we're making the decisions we're making and how those decisions affect their long-term goals. Everybody who has a business has a goal of selling that business at some point in time or transitioning that business to another individual at a point in time. And that is really how you achieve your long-term wealth planning goals. If we all wanted to be in nonprofit, that's what we'd be doing. But the truth of it is we're all in a business to make a little money and to build wealth. So asking why we're doing certain things is the most important to us and really what we try to educate people on.
And I love that Ryan is telling you guys to, think about your long-term financial goals and planning, because I totally echo what he's saying. If you have those goals in mind and you understand where you're going with your business, you have so much more power to plan for events, both on the tax side as well as on the revenue and expense side for your business and cash flow management. So, I think it's one of the reasons we work so well with M. White and Associates. It's they get that long-term planning and, really see how it's beneficial to small businesses on all angles. So I just wanted to jump in there and say it's such a, it's what businesses should be doing. And oftentimes I know you guys are all sitting there as small businesses going, I'm overwhelmed. I have too much to do. It's so well worth your time.
And that's exactly right. All professionals in our arena that help business owners should be educating along the way. You don't all have to be tax people. You don't all have to be accountants. You have to be good at running your business, but you do need to know why. It kind of starts with the legal arena, right? That's one of the areas that most people, to start a business, everybody knows you have to incorporate or build an entity structure. It's part of the business planning that the folks over LivePlan help you with. This is not ever what you want to see, however. A lot of attorneys get out there and they get in the same room with CPAs and they all start geeking out on the whole entity structure and tax planning and all that stuff, and this is what you end up with. This is not what you want. And I'm going to go into what you do need, but any guesses as to what big corporation this structure is for? All right. You all guessed it is Enron. Accountants make jokes at Enron's expense all the time. They crush the accounting firm, so we just do it. It's fun. The real question behind entity structuring falls into 2 buckets, right? There's the legal side and there's the tax side. On the legal side, why do we have entities? Well, we have entities for two reasons. To protect your business assets from your personal risk and your personal assets from your business risk. Oftentimes the example is, in your business you have an employee, they get injured on the job. Yes, you have insurance. Yes, you have all this other protection that can be in place, but the legal entity is kind of the end-all be-all to make sure that your personal assets that you've accumulated from the business, okay, are not at risk from any lawsuits that happen in and of the business. The same thing holds true on the personal side. And then on the tax side, what you have to understand is when we start talking tax planning, what we're really talking about is being efficient with the way in which we run transactions. Now, as a business owner, you take two hats and put both on, sometimes simultaneously. One as the investor and owner of the business, and the other area is as the employee of the business. Let's be honest here. Every business owner, if the job's not getting done by the rest of the employees, the job falls to you. So tax efficiency is one of the areas we jump into when we're talking legal structure. Sabrina, I wanted to ask you a question here. In your experience in helping these businesses get up and operational, what type of entity structures are you seeing most of your customers kind of get into or set up as?
You know, that's a great question, Ryan. And, you know, the answer is a good number of them are sole proprietorships. We definitely see a lot of partnerships. You know, then kind of split between C Corp and S Corp. But most of the entities that we see are still pass-through entities for small businesses, you know. And I'll let you describe a little bit more what, you know, the big picture of that means. But basically, your personal finances and business finances are a little more intermixed when it's a pass-through entity. The bigger thing, though, is too often we see small businesses that start up and they are an entity, but they haven't really created the best legal documents between the people who have founded the business. If it's two partners who maybe were friends, a lot of time it's, say, siblings or cousins, you know, some sort of family aspect. And what we see that, you know, we think is really a bad idea, and we try to get people to understand, is these entities being formed without a clear idea of, you know, very specifically who owns what, how is that owned, documenting who has invested how much money, and also documenting what happens if someone wants to walk away from the business, and how does that all work. And a lot of times we hear small businesses say, oh, those are awkward conversations, and we don't want to talk about the negative. And, you know, we look at it like, wow, this is like, you know, besides maybe a marriage from a personal perspective with a spouse or a significant other, this is a marriage, and you need to think of all scenarios, including if somebody has some life reason why they want to walk away from the business. And if you don't think about it, you're going to spend money in lawyers and legal fees, and things are going to happen that both parties are going to not be happy about. And so that's sort of the biggest thing that we see, is people will pick an entity type, but then won't go the next step and really think about all the pieces of what does that mean, if, especially when they're doing things in partnership.
And Sabrina, I've seen the same thing. Like you said, in a partnership, when there's two or more people involved, it can get ugly. It is a marriage. It is a financial business marriage, and oftentimes I've seen personal marriages end in a less harmful way than I've seen a lot of business marriages end. You're exactly right. Following through on the documents and following through with a partnership agreement that is well stated and clearly explained the duties, roles, and everything about that business, it really needs to be the guiding light behind the managerial decisions and the long-term business decisions that are made. What's commonly referred to as a push-pull or a buy-sell type of agreement should be included in there. It's all legal jargon, and a good attorney can help you out with that. but going out and setting up a partnership without a partnership agreement may have some tax benefits, but from a legal protection sense, it really kind of hurts you. So kind of go back to the slide, I'm totally in agreement with that. You see 4 types of entity types here. Sabrina mentioned the sole proprietor. That's on your 1040 as Schedule C. She mentioned the partnership down there at the bottom. The 2 in the middle, C Corp and S Corp. When she was talking about flow-throughs, and many of you already know this, your sole proprietor flows through, your S Corp flows through, and your partnership flows through. But some of you may be sitting there right now and questioning, well, I don't have any of these entities. My documents don't state any of these. I don't really understand where's my entity. And if you see here in the graphic, the LLCs, which limited liability company, many of you are probably set up in that format. These are state designations. Okay, you form or incorporate an entity type in a particular state. Okay, then on the left-hand side, the sole proprietor, C Corp, S Corp, or partnership, those are the 4 that the IRS recognizes. So you could be an LLC, and then from a federal tax standpoint, you have to then elect or make a decision to be one of those 4, depending on your circumstances. Getting into the advantages and disadvantages, this is kind of the meat of the legal and entity side of things. There are advantages and disadvantages, and there's more than just 2 advantages or 2 disadvantages for each entity type. But we thought we'd try to get it all on one slide and not make it look too nasty. From a sole proprietor standpoint, again, this is on your Schedule C, on your 1040. It's a pretty much an administrative ease, right? Because there's no board meetings or minutes that have to happen like there are in C Corps. There's not necessarily a partnership agreement because a sole proprietor is only one individual. And you don't necessarily have to keep up with a federal tax return for the entity. Now, on the disadvantages side, I spent a couple years with the IRS under the Self-Employment Small Business Division, and yeah, I was an auditor. I had no friends, right? So that's why I jumped back into public accounting. But it's one of the most highly audited areas of the Internal Revenue is the Schedule C, or sole proprietor business. And the reason is because just the way that they benchmark some of the statistical data that you put on a tax return, it can end up coming out in the wash where a number looks funny to them, and it's not necessarily that it comes in front of a person. It's a mathematical equation that they put into a software program. But the way in which that falls out, there's more data, and so it is more highly audited. Your partnerships, your C Corps, your S Corps have less of a risk of audit. Does that mean they have no risk? No, not at all. But they do have less of a risk of audit. The big disadvantage, however, is the self-employment tax. Self-employment tax, think about it this way, is payroll tax. Payroll tax is Social Security and Medicare. If you think back to the days when you had a W-2, you had your Social Security and Medicare that came out of your check. That was 7.65% of what you got paid. But keep in mind, your employer also paid the other half. Those of you that are employers now, you know exactly what I'm talking about, and it's that 15.3% Social Security and Medicare. On all sole proprietor income, you do have that self-employment tax. I'm going to move on to C Corps. C Corps, there are some benefits and deductions, mainly under what's called Section 125, or what's known as cafeteria plan. There's some different things that can go in there. A lot of times we use C Corps in conjunction with heavy tax planning. There's a $50,000 threshold whereby your tax rate can be less than it can be on your, or could be on your individual return. It's also something that you'll see whenever we start talking about some different types of deferred retirements or insurance type of models. And so C Corps are used in that respect most often. The disadvantage of C Corp, and this is very important, is the problem of double taxation. I'm going to go through a quick example, so bear with me. $100,000 of C Corp income, 35% tax rate. The C Corp owes $35,000. How do you get that money out of the C Corp? Well, you have to give it to yourself either as owner wages, or you have to give it to yourself as dividend income. Either way, we've already paid the tax once at the C Corp level, and now when it comes under our individual return, we're going to be taxed again, therefore double taxation. So the effective rate on that one source of income can literally double or thereabouts. The other disadvantage on C Corps is a great deal more of administrative burden than on some of the other entity types. Moving on to S Corps, this is the most common that I see. I do more S Corp returns than anything else. And a lot of the reason is because individual single owners benefit most from an S Corp entity model. The advantage there is that we can designate part of their net profits that they can distribute to the owner as either tax-free distributions or as owner's salary. Now the problem is the tax-free distributions are tax-free, but like Sabrina mentioned, flows through entities. If the net profit, the distribution amount, does flow through to your individual return. The good thing is, different than a C Corp, it's not taxed at the corporate level. It's only taxed once at the individual level. Well, then you could probably look at me and say, hey, Ryan, why don't we send it all through distributions? Because then we don't have to pay any payroll tax. But Congress, despite what some may think, is smarter than that, and they figured out that they should add a clause in there for anybody who's an S Corp that states that you have to have reasonable compensation. So that pretty much closes the hole that allows us to be able to send it all through distribution. So there is some that has to go through as owner wages. I could talk offline more about the percentage there and how much I feel in a case-by-case basis should go through, but that's where you pick up the biggest tax advantage in an S corporation.
Ryan, there was a question from someone, but I think it gets into some specifics, so it's one of these that I think we will follow up in an email with more resources on, you know, C Corps and S Corps and partnerships and pass-throughs, because Sarah asks, how does she and her husband formed an S Corp and wanted to know how business finance separates from personal finance. So that question, Sarah, we'll make sure we follow up with a section all on the advantages and disadvantages of entities from a tax perspective, giving you some links and resources to check out after the webinar so that we can keep moving along.
That's perfect. That's perfect. And that is a very important question to understand, especially in a flow-through environment. The disadvantage, the primary disadvantage on the S Corp side is whenever you get into a multi-owner situation like that, S Corp law requires that everything gets split according to ownership. So if you have two owners in an S Corp that are 50% owners each, and yet you want to give a distribution to one person more than the other, same $100,000 we had in the C Corp, say it's in an S Corp, and you want to give 60 to one person and 40 to the other, S Corp law keeps you from doing that. Everything has to be according to ownership. Same thing with net profits or net losses. Now, on a partnership, one of the biggest advantages is that we can split net profit and distribution and things like that unequally. I didn't put that one in there. I probably should have, but that's one of the bigger advantages and differences between partnerships and S corporations. Another big advantage of partnerships over S corporations is that any debt that you incur or personally guarantee that's from a bank or a third-party source, you get what's called debt basis for that. Basis is a very complicated thing. I'm not going to go into depth here, but just know that when you have basis, you're allowed to take net losses up to the amount of basis you have. Disadvantage, going back to an S Corp, the difference between S Corps and partnerships, is that that third-party debt basis is not there and is not allowed. Okay? So when you have multiple owners, that can be an advantage to go with a partnership versus an S corporation. The disadvantage to an S corporation, the biggest thing is some of it has to be subject to self-employment. The active participation and your active generation of that income per the IRS, would theoretically have to be subject to self-employment. There's some real gray areas there, so I don't want to go too deep, but just know that that's what it is. I do want to pause for just a moment here, because just because you have an entity, and many people come to me, oh, Ryan, I set up a business, I have an entity, how can I save on taxes? Well, they're equivocating the business setup and the new legal entity structure with the ability to be able to take bigger deductions, and that doesn't work. Planning, knowing what you can deduct, knowing what you do have in revenue, and knowing what your long-term goal is, from a holistic approach, is the biggest key to success in trying to be tax efficient. So now that we've gone through entities, let's kind of get into some of those deductions. So from your deduction standpoint, in a business, it really falls into two categories. It falls into the employee benefits category, what's known as Section 125 in the Internal Revenue Code, or it falls into your regular business deductions. We can talk all day about specific what-if scenarios on the business deductions, meaning should I run the car through the business as an auto expense, or how much is too much for meals and entertainment, or hey, the trip to Puerto Rico or wherever you want to go, is that a legitimate business expense? Can I run that through the business? And the answer to that is, and you're not going to like this, but it's a case-by-case answer. It depends on the business purpose, okay? And also, you don't really want to, if you're going to incur the expense and it's on your personal side, that doesn't necessarily mean, well, I really want to take a tax deduction for this, so I'm going to run it through the business. We think about everything on our side from two perspectives. One, being efficient with our tax dollars, and two, looking at the long-term overall objective, right? So just putting money through the business for a tax deduction isn't necessarily achieving what we want to achieve. Now, on the employee benefit side, a lot of people, especially with the Affordable Care Act, and I don't necessarily want to get into that topic because that'll open up a whole can of worms, but the health insurance, life insurance, auto allowances, continuing ed, tuition reimbursement, this is stuff that you typically see in any big corporation in America provided to their employees. On a small business level, the purpose of running it through the business instead of outside of the business is to be able to pick up the business deduction for it if you're going to spend it anyways. Now, the difficulty is in employee benefits, what you offer to one person, meaning you as the owner, you have to then also offer to all your employees at the same level, meaning the offer has to be made. It doesn't have to necessarily be made at the exact same dollar amount. It's on a contractual basis. But like I said with the planning, before we really start talking about how to be tax efficient and getting deep into those deductions, you have to know where your money's coming from. This is, again, where we look at a holistic picture of things. There's really three main sources of income. Payroll, business income, that's your flow-through profit, or your investments. That's a little more complicated because there can be dividends, interest, or capital gains. And there's different tax rates for those, okay? But there's three main income sources, and planning and knowing where that money is going to come from helps us in the tax efficiencies. Or to say that in reverse, to be tax efficient, we need to plan which way we want the money to get to us. Okay? There's four types of taxes on those three types of income. Individual income tax, payroll tax, that's the same thing as self-employment tax, capital gains tax, and then this new one for this year, or not this year, but last year, 2013, is the Medicare tax. Let's take a look at what type of income sources we want, right? What's the worst and what's the best? Well, if we're planning for tax efficiency, the worst type of income to have from a effective tax rate perspective would be payroll income, your wages that come from your business, because that's subject to your individual income rates, which can be between 10 to 39.6, plus you're going to have payroll taxes, which is around 15.3. Now, there is a Social Security phase out, but we don't want to go there. So in total, the payroll is somewhere under 54.9%. That would kind of be the max. Okay. Then we move to income from passive investments. This would be dividends. This would be interest. This would be kind of some flow-through income from a passive investment you made in it from an equity perspective. That's going to be taxed at income tax rates on the individual side, 10 to 39, plus this new Medicare tax, which is on passive investment income. That tax rate is 3.8. So from your passive investments, you're looking at just under 43.4. Okay. Now the business income. This is from the flow-through side. Okay. Not talking sole proprietor Schedule C here, because that would fall back to category number 1, payroll. But from the business flow-through side, this is only taxed at the individual income tax rates between 10 and 39.6. The last one here is your long-term cap gain. The reason this is most beneficial is because of the favorable long-term cap gain tax rate of 15 to 20%, depending on your income thresholds, plus the Medicare, because this is a passive ownership investment, of 3.8, so totaling somewhere around 23.8. Most people, when they build this wealth in this business, take the money out through payroll and business income as they move forward over the years, and then when you go to sell it, you get long-term capital gains. Okay? What you have to know is during that process of earning your wages and your flow-through business income, how should that break down? At the end of the day, if I run more deductions through the business, keep my wages the same, I have less business income. Well, so now should I divert some of my wages to business flow-through income instead of having it in payroll? That's a discussion that needs to happen. Working with a company like LivePlan and using the scoreboard feature that I love so much about that software, we're able to actively plan with our clients in knowing in a real-time basis where we are from a financial performance perspective and moving to making decisions that help us on the tax efficiency front. Sabrina, I kind of wanted to pass this on to you from the LivePlan standpoint, because planning for the income, planning for the tax efficiency really has to come down to business planning.
Exactly.
What type of planning or usage are you seeing by your customers in that scoreboard feature or with the business plan software itself?
You know, what really, it's exactly what you're saying, right? What we see is the people who are using, say, the LivePlan tool to do a budget and a forecast and then bring in their accounting data and see the actuals are the people who are most aware of all the different variables that are affecting their business, right? So if they're watching these financials, they're going to have a couple of key pieces of information before they would have it if they're not watching them. So, you know, if you all of a sudden realize, oh my God, I'm way more profitable than I thought I was going to be, it's a lot better to realize that in, say, July rather than in December, assuming you're on a calendar year in terms of your fiscal year. Let's just pretend, because that's easier. Everybody's on a calendar year. So to find out that you're way more profitable than you thought you were going to be in December gives you a lot less time to plan your approaches to that profitability. In our business, I'd rather think about ways to spend that money smartly and reinvest in the business rather than to pay Uncle Sam taxes. So some of it will be tax planning that we do with profits, where we start to look at our profits a good 6 months before the end of the year and say, hey, looks like things are going really well. Let's really look at employee bonuses. Let's look at things that we can legally spend this year to bring those profits down. And then we finish off the year with minimum taxation on our profits. And when you plan and when you look at what's happening versus what you plan to do, it allows you to do that. Because a lot of the times, business is going so fast and business owners are just happy that things are profitable and there's cash in the bank, and they're not stopping to really think through, wait a minute, things are going so well that I need to rethink things. You know, it might be time to think about giving some raises and some bonuses, and maybe there's some marketing programs that you never thought you could afford, and this is the time to do them. But you can't book a bunch of marketing programs in December that aren't going to happen until January and legally claim that. It's, you know, you have to do things in the year that you have the profits. And so that's where the planning and really comparing to your actuals comes into play.
And that's perfect. That's how we've used it with our clients. The benefit of that scoreboard feature in LivePlan, I can't even explain it. We have clients hooked up on it right now, and they call me all the time. Hey, did you see how well I did last month or this last couple of days? Because we have it in a real-time fashion. We do the accounting in a back office sense every single day so that they can go in and pull a P&L or pull the dashboard every day and get a good handle on where they are, and mid-month be able to make managerial decisions that will help them achieve their goal for the month. If, you know, they're ahead or behind, it really helps them long term. The other thing, and this is what we're about to get into, is the biggest tax savings tax tip. I'm about to show it to you, but the real thing you have to understand before we get into it is planning. You have to know if you're going to have the money to do this. Because if you don't and you get to the end of the year, I had a client who called me up yesterday and he said, hey, Ryan, can I not make that investment because we didn't plan well enough? And he's a client who I don't have set up on LivePlan because he elected not to be there. And now we're having problems trying to figure out how to scramble and get the money to be able to make the contribution. And what I'm talking about, back one more, is deferred retirements. These are the things that really help to increase the efficiency from a tax standpoint. And the reason is because we earn the money today, we save it until tomorrow, or in most cases, it's many years from now, and then you pay the tax when you're in a lower tax bracket. A deferred retirement vehicle, think back to the 401ks you had when you were an employee at one point in time, or an IRA. The thought process, or the theory here is, I want to drink from a water hose, a garden hose, rather than from a fire hydrant. And the reason is because I can take that garden hose and turn it off and turn it on and turn it off and turn it on. It's much less of a flow, and I can control it. A fire hydrant, you just open it up and you're going to get hit in the face. Deferred retirement vehicles fall into two buckets: defined contribution and defined benefit. Defined contributions are just what I mentioned, 401ks and IRAs. Now, there's all sorts of variations: simple 401ks, SEP IRAs, simple IRAs, Roth IRAs, traditional IRAs. There's a whole type of different defined contributions. But what you need to know the defined contribution is, it is based upon the election by the employee versus a defined benefit. A defined benefit, think back to the old GM, GE pensions. Okay? They're now referred to as profit-sharing plans in a small business community. Defined benefits are based off of a percentage of your salary and the profit from the business. Okay, so that's the main difference. Defined contribution is an election. Defined benefit is based off of other factors, not to mention the net profit of the business. Both of these types of defined deferred retirement vehicles are governed by what's called ERISA, Employee Retirement Income Security Act. That's the governing body that if you wanted to run out and start your own C corporation while you had your business, and the only employee in that C corp was going to be you because you wanted to be able to only contribute to a retirement plan for yourself and not your employees, ERISA is the one that pulls it back in and says, no, 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 I see what you're trying to do, and ERISA says you have to give what you give yourself or offer yourself to your employees. I'm going to go through a real simple scenario, so bear with me here. Just think through this. We have $1 million business, annual revenue, $120,000 in payroll costs, $640,000 other overhead. Your net profit is $240,000. Well, say you turn to me and you say, Ryan, I need $15,000 a month to live. Mortgage, eating out, car payment, whatever it may be. I need $15,000 a month. That's $180,000 a year. So I would turn to you and I would say, great, you have $60,000 that we can use to be tax efficient. So how are we going to do that? On the left-hand side here, you see the example by not making deferred retirement contributions. And on the right-hand side, you see the example of making the deferred retirement contributions. So you have to take your net profit of $240 and then say you're going to max out your contributions to a 401k. Well, the max is $17,500. See that in the middle of the screen, the owner, $17,500. The 401k safe harbor match, which is the amount that you have to contribute in order for you to max out, is 3%. Remember, I said our payroll cost was $120. So that means $3,600 goes to our employees. Okay, that's $21,100. Then we layer on top of that a profit sharing plan, a defined benefit deferred retirement vehicle. Actuaries derive figures for how much as an owner you can contribute to this. It's based off age and net profit and a whole bunch of other factors. But just imagine somebody who's about 45, maybe 40, can contribute $30,000 as the owner. The safe harbor match for defined benefits is somewhere around 7%. But remember, we already gave away 3% in the 401k. So we give away that additional 4% in the profit sharing plan. The total of our deferred retirement contributions for the owner and the employee is $55,900. Now that brings our new taxable net profit to $184. And you're probably thinking, why in the world am I giving away $55,000? I'm about to show you. So if you look on the left-hand side, our tax at a 35% individual income tax rate, think of an S corporation, is $84,000. So that means our after-tax earnings are $156. Now remember, we took that same $240, we subtracted the $55,000 we put into the deferred retirements for us and the employees, and now our new taxable net profit is $184. At 35%, that brings your income tax to $64,435. So your after-tax earnings, which you physically take home after you pay your taxes, is $119. You're probably thinking to me, Ryan, I need more than $119. I was going to get $156 if I didn't contribute. Well, yes, you're right. But remember, we also have that $47,500, the $17,500 for your 401k, and the $30,000 for your profit sharing plan that's now an investment. So the real difference is $167,000 in net wealth increase, your after-tax earnings plus your investment, minus your $156, which was your after-tax earnings. So you saved $11,165 on your taxes and have $47,500 sitting in an investment account. That's a simple scenario. I know it may not have seemed all that simple, but that's how it works, and that's how you really start saving some tax dollars. I don't want to get, the deferred retirements are huge. If I can save you on taxes before you put the money in your pocket, I've done my job. If you put it in your pocket and then come to me and say, hey, Ryan, I want to save on my taxes, it's going to be very difficult for me to do that. So deferred retirements are the key and biggest perpetuator of tax efficiency and tax savings. I'm going to briefly go through estate planning, and I don't want to stop here very long. For those of you that have some very quickly, rapidly growing businesses and you're accumulating some serious wealth, know that estate tax planning is going to be a huge concern for you, and I want to walk through that with you. There is this thing called a death tax of 40%, that if you have assets in your estate, in your name, of $5 million or more, and I actually think it's 5.37, then you will be subject to the death tax of 40% if you were to pass away with those assets in your name now. The goal for CPAs and attorneys is we take those assets out of your name and we put them into a separate vehicle. In this case, I highlighted a family limited partnership. So you gift them into the family limited partnership and then you gift them to your heirs. It's extremely complicated. Like I said, here's the things you need to understand. Do you have a business that's growing super fast? Do you have significant assets that are accumulating in your personal name or will begin to? Or do you right now have significant assets at or close to the $5 million mark? Just keep that in mind. We can take that entire estate planning thing offline, but I did want to point that out to you because that is a significant tax savings break there. A couple of tax myths debunked. Two of these are new for 2013 and 14, so So I did want to make sure we covered the interest and the depreciation. The others are some common questions I get. The first one, interest deductibility. After 1/1/2013, your mortgage interest is no longer fully deductible if you are at certain income thresholds, and the thresholds differ between single, head of household, and married filing joint. This has changed our mentality. If we have an interest rate on our personal mortgage of 3%, and we only get to deduct 50% of our interest that we paid because of the new laws, and we have an interest rate of 6% on our business loan, guess what? Those are now equal because we get the full deduction at the business level. Okay, so that's something to consider when you look at what I'm going to pay off and the usage of your monies and paying down your debt. Which one should we do first? The next topic is depreciation. This is a big one, especially for those of you that are in high CapEx businesses. Anything in the past, we used to write off depreciation at an accelerated level very, very quickly, and most of it all in 1 year. Now, as of 1/1/14, it's down to $25,000. We don't know yet. There is word out there that that's going to come back up to 147 or some number like that. We have no idea, and I am not planning on that coming back up. I'm tax planning for just the $25,000 in what's called Section 179 for 2014. So those of you in high CapEx businesses, look into leases. I know that's not ideal, but from a tax efficiency standpoint, it could actually be more to your benefit. The next thing, and I hear this most often, and even when Sabrina was talking earlier about spending on marketing and things like that, if it's for the business to grow the business, it makes sense. If you need it, buy it. If you do not need it, there's no reason for you to ask me, Ryan, I need more business deductions. What should I spend money on? If you don't need it, there's no reason to buy it, because all you're doing is saving 35 cents and you're spending $1. I don't know about you, but I'll keep my 65 cents all day long. So
and that's great advice, Ryan. I'm so glad you said it, because, yeah, you're right. I don't want people to confuse what I was saying. You know, if you need it and if you felt like you couldn't afford it and all of a sudden you can, great. That's when you go out and spend it. But Ryan's right. You don't want to just spend to not pay taxes. But, you know, especially those of us who have weathered the economic downfall, I think a lot of us didn't give employees bigger raises and bonuses because we were just trying to get through this recession. And so if it's, you know, if it's a place where you feel like you're going to get a big benefit, understand and know that you have the money available. But if it's not going to give you a big benefit, I am with Ryan. Don't spend the $1 just to save, you know, the 35 cents. Just keep the $1.
That's absolutely right, and that's a question I hear so often, especially at the end of the year. Being efficient with your money, going back to the deferred retirement thing, at least then you get a business deduction, but it's still your money. And that's why it's such a huge plan for us on the tax side to use those vehicles. The next thing I hear questions about is, should I put my spouse, significant other, or child on payroll? The only thing you need to understand here is if we are doing it for deferred retirement purposes or for some type of insurance purpose, it makes sense at certain ages. If we're not, and we're just doing it because we think it'll help us on our taxes, that it necessarily won't. Because if you're filing a joint return, you pay your wife $50,000, you reduce your business taxes by $50,000, or your business income by $50,000, but now you pick up that $50,000 from her wages on your personal return. It's a net zero-sum gain. And that leads me directly into the next point, management companies. I hear a lot about management companies. And because our firm specializes, or we work a lot in multi-entity situations, management companies are a huge play for us, but they're not for everyone. They're used particularly for efficiency in administration. They're used for efficiency in an ownership type of structure, but they're not necessarily something to just set up because now you have two businesses and you need a management company because you think it'll help you save on your taxes. It won't necessarily, because you reduce your business that's paying your management company by $1 and you pick up $1 in your management company. It's the same thing. It's like having $2 in my right pocket, taking one of them out, put it in my left pocket, and then you ask me how many dollars I have. The answer is still 2. So management companies are good. They're used for structuring certain transactions, but they're not for everyone. So don't get fooled into thinking that, hey, I need to go out and set a management company. I read something about it on Google. Again, go back for good guidance, good advice. I can't tell you that enough. Sabrina, that's kind of all I have. I know I covered a lot, but the biggest thing here is just kind of get some topics out there to get some good questions in and be able to follow up with those kind of offline later. So anything you think I missed?
No, I think you were very comprehensive. We definitely had a good number of questions that I was fielding while you were talking about. So we will be following up with some links and resources on where people can understand a little bit more about whether they have chosen the right legal entity. I do also want to make sure I emphasize what Ryan was saying is you've got to think about your goals and objectives, because there's not one entity that's right for everyone. It all depends on what you're trying to accomplish. So we'll send some resources out, and this is why people work with Ryan and M. White, because the next step after you start to understand the pros and cons of all the different entities is to really then match it with your financial goals, the time, your time in life. Do you have kids that are young or old? Are you thinking of passing the business on at some point? I mean, there's a lot of different factors to think about, and depending on where you are in your business life and in your personal life, those factors will end up pointing to different kinds of entities. So there's not just a one-size-fits-all approach, but we'll follow up with resources on that. There's a couple of people who joined us internationally, UK and Canada, where tax laws are different. A lot of the same principles apply, though. You don't want to go spend money just to avoid taxes. You want to think about the right entity in those countries as well. So we actually,
Sabrina?
Yep, go ahead.
One of our partners, his name's Eddie. He's actually from Ireland, but has done a whole lot, worked for KPMG for a number of years, and worked on an international basis. So from that perspective, if there's questions people have, we'd love to field them even on international taxes, because he's very, very knowledgeable, and I'm sure we can get those answered for folks.
Great. So those of you who ask questions about Canada and UK, we'll send them on to Ryan, and the follow-up email that we have thanking you for attending the webinar, giving you a link to the canned webinar, which will also have all the slides in that canned webinar. We'll also then address some of those international tax questions. But definitely, Ryan, I think you did a really great job. And like I said, it looked like there was a lot of questions about the entity. There were some questions, actually. Someone asked one question that might be a quick one for you to answer. Sarah asked about long-term capital gain and what is that. And maybe you can just give a short little definition. We will make sure that we send you a link in the follow-up email to just definitions and resources for all these tax terms, so you can just look things up. But I thought that one might be a nice, easy one in the last 5 minutes for you to answer, Ryan.
Absolutely. Long-term capital gains are whenever you have an asset, and an asset is defined as something that creates money for you. If I go buy a building and I rent it out to someone, that is an asset that is driving rental income. If I buy it for $500,000 and, I don't know, say it's a really good year, I sell it for $1 million a year later, as long as it's past a 12-month mark from the time I bought it to the time I sell it, it is a long-term capital gain. And so capital gains are from holding investments, assets, and then later selling them for more money than you purchased it for, and it's just kind of that straightforward.
Great, thank you. That I think was really helpful. There's, again, a couple more questions here, but I think we are going to send out as many resources as possible. And then one of the questions is Pamela's wondering if there's someone she can talk to about questions that aren't tax related. Pamela, if they're related to starting your business, check out bplans.com. I'm going to put it into the answer here and send it to everybody. It's a free content site that we actually run. It's not a sales site, it's just content, and it's all about starting a business. So start there, and then go ahead and tweet me, Mommy CEO, @MommyCEO, and ask me any questions. And if it's tax related, we'll punt it over and have Ryan and maybe some of his associates help us out. If it's related to starting a business, we will point you in the right direction. We want to hear from you guys, and this is why we're here providing all this information. So,
well, and one of the things, Sabrina, one of the things we offer from a business perspective is more of a fractional or part-time CFO. So once you kind of get up and running, we do have a department of tax folks, and then we have a full-time department of consulting individuals as well that help to take that business plan and that business startup plan and really turn it into a reality on an ongoing relationship basis. So that's also something that if anybody has questions about that, we can definitely help them out. We've started many a business.
Great, great. So you heard it there. So that's great, and we're pretty much here at the top of the hour. I can see there's still a couple more questions. So, you know, Kelly, Louise, Pamela, don't fear. We will make sure to follow up and give you guys access to resources and people so that you can get your questions answered. It is a timely topic, and like Ryan said, you know, it's one that sometimes can stress people out if they don't know, and going to Google maybe stresses you out more because there's just so much there, and you don't even know what is right and what you should trust. So we'll work with Ryan and M. White and Associates and put together this email with lots of resources, and also how you can go to M. White and get additional help, and how you can get access to get some more information about tools like LivePlan to help you really manage your business in the best way on an ongoing basis. So with that, at the top of the hour here, I'd like to thank everybody for joining us. Ryan, thank you so much. There's so much great information here.
Absolutely.
And, you know, based on a lot of these questions, we'll probably be following up with Ryan and doing some more webinars. It's been great to see how many people attended and how many people are really actively interested in asking questions. So this is exactly what we wanted to see, and will help us determine some topics for our future webinars related to small business and taxation. So thank you, everybody, and you know, contact us, contact Ryan, but wait for that email because there's going to be a lot of information in it. Thank you very much.
The